Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Miami at Exchange and ETF Experience, where I'm meeting with the top thought leaders and innovators in the ETF space. Joining us for this segment, we have Byron. He is the global head of ETF Solutions at JP Morgan Asset Management. Byron, it is great to have you with us. Welcome to Trade Talks.
Thanks, Jill. It's a pleasure to be here.
It is a pleasure to be here. It almost feels as if it's a high school reunion. All of us in the industry get to meet with each other again. And I think the topic of conversations and what advisors are focused on has been really interesting as we go through these interviews at the conference. What are you hearing from institutions and advisors top of mind?
Yeah, it does have a reunion feel to it, but it also is really exciting because there's so much innovation happening and there's all the new ideas and people bringing their new ideas to this. So it's like almost like multiple high school reunions of people getting together. It's certainly an interesting time to be an investor right now. There's a lot of uncertainty in the market that people are trying to adjust their portfolios for. Some of the major themes are, of course, inflation, and knowing that there's going to be rate hikes coming forward. Investors are trying to look for areas to find income while not getting punished by a rising rate environment. So one of our strategies, it's equity premium income. The ticker is JEPI, J-E-P-I. This is an equity portfolio with a covered call overlay that drives premium income off of that. So it targets a 7 to 9% distributable income, but because it's an equity portfolio, you're not taking on duration risk. So you can still accomplish the outcome of income without taking on some of the risk of duration in a rising rate environment. Another thing that we're hearing a lot from investors right now, sophisticated investors that maybe have a little bit of cash in their portfolio, they're looking for a way to step out of cash and maybe get a little bit more yield for that, but again, by not taking on too much duration. So we have two strategies in that space, JPST, which is the ultra short, and JMST, which is a muni ultra short. Now this is a fixed income strategy, but the duration is less than 1 year, and it gives you a significant increase in your yield above and beyond cash, so you're stepping out of cash, but again, because that duration is stayed in, you're not taking on too much duration risk. And then the last one, I'll throw in a wild card here on investor trends and just what we're seeing out there is thematic investing. And thematic investing has grown significantly over the last couple of years. I think it's because investors want to know what they own, and they want to invest in things that they care about. And so one of the strategies that we offer there is climate change solutions. The ticker is TEMP, T-E-M-P, and it's all about companies that are investing in renewable energy spaces across industries that'll benefit from the shifting environment of moving away from more traditional energy sources to others that will benefit potentially from investments going and addressing climate change issues.
Yeah. What do you think are going to be the biggest challenges for 2022? Because there really is a generation of advisors out there who have not lived with inflation. I mean, you're looking at advisors from the 70s, 80s, and you don't really have that experience with the significantly high inflation. And we had Tom Lydon on before with us. It's like most of those guys aren't even in the business anymore,
right.
And you have a newer generation that is going to have to learn how to manage their expectations and client expectations.
Yeah, but so yes, we will have to do that, but we do know that history may not repeat, but it certainly rhymes. And it's actually a decent time to be an investor from an availability standpoint. What do I mean by that? Investors have more tools than ever to build portfolios. So some of the strategies that we've just talked about are designed intentionally to help them invest in these environments. Now, our strategies, many of them are actively managed strategies, meaning we have a portfolio manager that many of them have been investing for decades and have been through inflationary environments. And with an actively managed strategy, they can intentionally adapt their portfolio to deal with the environment that they're investing in. So if they want to pull in their duration because they're an active fixed income manager, they can do that. If they want to be more selective about the credit risk they're going to take on, they can do that. They don't just have to follow whatever the index is doing. So that differentiates them massively. And they're able to address the portfolio in different ways. And so I actually think there's a lot of active strategies that are providing a tremendous amount of value for investors to, look, it's not going to be easy to invest in this environment, but to have the tools to run appropriate portfolios that give them an opportunity to succeed.
Byron, I'm so glad that you brought up active management, because when I started covering these conferences 5 years ago at this point, it always seemed to be the passive versus active, David versus Goliath argument. We weren't thinking about active in that way.
Yeah.
I mean, the market was only going from the bottom left to the top right of the screen. It seems as if the pendulum is shifting back, and over the past 2 years in the environment that we're in right now, you can see the value of active with this market environment.
Yeah, the active versus passive debate, the versus,
right.
like I'm going to say that was hogwash. right?
Right.
Like that was always a misplaced argument that didn't have to be the case. What the true answer is you need both. They can both play a role in portfolios. And there's different exposures where a passive exposure might make more sense. There's different areas of the market where an active exposure might make sense. And actually for investors now, what we're seeing is they're combining those two in their portfolio. Right. And to do some of the things that we've talked about on the active side, the outcome-oriented strategy, I mentioned Jeppy earlier, that's driving a 7 to 9% distributable yield with active management, where we're managing the risk of the underlying portfolio with a portfolio manager that knows exactly what they own and why they own that in this environment. That's a tremendous amount of value, and that's a great tool that investors have to invest in portfolios. And sure, passive plays a big role as well, but investors need to be aware of the limitations of passive and the limitations of active, and making sure that they're understanding both of those as they build their portfolios. But to your point, active, delivered through the ETF technology, trades throughout the day, tax efficient, transparent, but with active managers that are intentionally picking their portfolios. I think that's innovation that really benefits investors in the long run, and we're seeing investors embrace active ETFs. So, active ETFs only make up about 4% of the overall AUM, but they're 10% of the flow over the last 12 months, meaning that investors are disproportionately adding to active ETFs vis-a-vis passive ETFs.
Yeah, and it's interesting that you're talking about the ETF advantages, because another hot topic has been mutual fund conversion into ETF for those reasons. So to your point, I think the tax treatment is what key. It's what key there.
Yeah, so we at JP Morgan actually over the weekend just converted our first mutual fund to an ETF.
Oh, well, there you go. That was fortuitous.
So we had a strategy, inflation managed bond, which was a $1 billion plus mutual fund, and it's inflation managed. So it's active management around helping investors deal with inflation in their portfolio. And we converted it over the weekend, and it started trading on Monday as an ETF. And so it's, as I like to say, went to bed a mutual fund on Friday and woke up an ETF on Monday, and it's been trading. And to your point, we do think that there's some benefits to the ETF wrapper, that perhaps this strategy delivered through the ETF wrapper is really exciting for investors. So we lowered the expense ratio. We also obviously know that we're going to be 100% transparent on what's in the portfolio. And we do think that there will be some tax benefits. Of course, it's different for everybody, but there will be some tax benefits with it being in the ETF wrapper. We've announced 4 conversions, so we've done the first one. We've got another 3 planned between now and June.
All right, Brian, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.